Cool. All right. So today I want to go over something that really a lot of smart money can be summed up into one of these two things. And the whole idea with smart money, I think that people get absorbed into and get consumed by is, they get consumed by trying to understand 1,000 different concepts. So one thing I want to make a big point of is don't try to understand and implement, if I can type, every single ICT concept. So, this is where a lot of people mess up, and they've watched, all sorts of videos and hours of content trying to understand how to, perfect a breaker block entry, perfect, ES scalping entry, perfect, a weekly power of 3 one shot, one kill, perfect this, and, the daily power of 3 and catch the daily range. And it gets to the point where it's so overwhelming that instead of actually getting anything done, you just run around in circles, or you become one of those traders who is more or less just like fascinated about ICT stuff. Or like just hindsight, like, oh, this is neat, this is cool. But at the end of the day, you really have to spend time figuring out what works for you and perfecting whatever it is that you understand the most, or what's working. So if you try to watch, so many people, they'll watch all of ICT before they even trade. And while I do recommend there are steps to it. You need to learn, and you need to refine, and you need to practice on a demo, and then start with a small account and then work your way up. But so many people just get so lost in like the cult type ICT stuff, where it's just like, it's more fascinating, or it's like cool. But it's like the reason we're learning this is to make money. So you have to learn to take out what matters from all of this and be able to implement it into an executable strategy. So, conceptualizing is key. So, understand the foundational concepts. So what are the foundational concepts of ICT or any smart money concepts? Because, hate it or love it, there are different variations of smart money concepts, and people have taken the original foundational concepts and then built their own strategies. I'm not going to, there's a lot of people say, oh, everything is just a carbon copy of ICT. It's just simply not true. A lot of people have taken the idea and then went back and tested and found different occurrences in price and different ways to read price, but it's all based around the same narrative. And that narrative is, and again, it goes all the way back to Wyckoff, back and way before ICT was even born. So I'm not going to sit here and say ICT invented this, ideology. I think that if you ask anybody over the last 50 years, hey, do you think the stock market's manipulated? Or hey, do you think, whatever is manipulated? The answer is yes, right? It's human nature that anything that has a ton of money in it is manipulated. So it's not like news, it's not like ICT just like cracked that code. But most people who are kind of branching off in the SMC, price action trading space, that ICT definitely made that a little more popular. So, but you have to understand the foundational concepts. And these patterns are occurrences that happen across all time frames. They happen at key points of day, or they happen at key points of the year. And they kind of ties nicely into the last lesson, which was the time and price lesson. But really the value and what really started to make ICT stuff click for me was understanding, how to I guess generalize the teachings and then use them for yourself. So power of 3 is going to be one of the patterns we're going to talk about today. So, a lot of people call it AMD, and they'll say like, oh, AMD isn't power of 3. Yes, it is. It 100% is. Go back to old ICT, it's literally called accumulation, manipulation, distribution. Now, this concept, oftentimes plays into Wyckoff. So I'm not going to say they're one are right or wrong. They're just different ways of interpreting it. But what are the premise of both is that the market is being manipulated, and then that liquidity is taken advantage of. So again, accumulation, which is where we get that the market is being manipulated, so to speak, because we're building up a range where there's all sorts of people with stop losses or buy stops, sell stops, whatever kind of orders. There's a lot of liquidity on both sides of the range. So all that is just a range is being engineered because let's say if a massive player wants to get in, they're going to need liquidity to do so. So they're going to have to create it. That's why they call it engineering liquidity. And they do that through the chart. And this is, we talked about what market makers do in the liquidity episode of this crash course, which like Citadel, it even says in their websites, they make for a tradable market. So what does that mean? Well, that means that if you are a massive trader or, a massive player, you're going to need to, have available liquidity. And market makers are able to manipulate markets and kind of keep things under control, keep things attractive to traders. So if we can understand that everything kind of is based off of the whole AMD or the whole manipulation, right? Then we're able to really look at things, like a lot of people call it the Judas swing. And I remember for the longest time when I was trying to learn this, in the first month of like the older ICT stuff, he talks about, the 4 types of the market, the expansion, retracement, consolidation, reversal. And also talks about the different characteristics of different sessions, where we have the Judas swing in London and consolidation in Asia and subsequent expansion during London and retracement and then expansion in New York. So again, what does this all come down to? It comes back to the Asian session in that concept, which is accumulation. So again, accumulation, manipulation, distribution. And this is literally everything about smart money concepts can be summarized into this right here. So whenever you're trying to look for a model, and you can, let's just say if the market has given you some price action and, let's say there's some point of interest down here, whatever it is, fair value gap. I'll draw something a little prettier. Fair value gap or whatever the fuck it is. It doesn't matter. It's just an area of interest. All fair value gaps, demand or order blocks or liquidity pools or mitigation. I mean, all of them, what are they really? They're just an area of interest. They're just somewhere where you look for triggers. So you want to see accumulation near those areas, right? And then, the manipulation is the sharp push. And that's where we look to get involved. But nobody really looks like this. Like a lot of courses will teach it like, oh, this is just a liquidity sweep. And that's what it is. It is that. But when you really think about it, every time that a good trade happened, there was accumulation, manipulation, distribution. Whatever time frame it was on, it doesn't matter, but you're able to go back and most trades, they were in some form or fashion the power of 3. So when you really start to look at smart money concepts as something that should require all 3 of these elements for a proper trade or a high value trade, then you'll start to look at things a little bit differently. And I think things start to click, or at least that's what really started to help me, was understanding that it's all the same. No matter, if you're trying to trade Quasimodo, no matter if you're trying to trade just simple order block, pro structure or whatever it is, it all comes back to power of 3 as far as the whole concepts of what's going on, like why you're using it. Now, of course, there's other stuff, like you need to understand structure and everything else to get your bias right, which we went over. And I'll have another episode on bias in this series, but once you can grasp that everything comes back to this right here, as far as you getting involved, it'll save you from getting into a lot of low value trade setups. So there's the manipulation into your whatever area of interest you had. And then you have your structure to confirm it, and then distribution. So you're just going to target opposing liquidity. So I'll show you guys a couple examples of why I was targeting levels I was on GU. We talked about this. Let's do ES actually. ES is a really good example right now. So whenever you take out one liquidity pool, so let's say we took out buy side, right? Whenever you take out buy side into a context that tells you should reverse. So for instance, let's say if there was a massive fair value gap here. Let's look at ESZ because it's a little cleaner. There's or wait, not ES, or not, I thought it was, never mind, sorry. ES1, not ESC. So whenever you look at this chart, the only reason I wanted to switch was because this is different on another chart. There was equal highs. So this was equal highs on the more recent charts. Just keep that. Hold on. Yeah, I was like, am I tripping? So these were equal highs. So this will be a little bit easier to see. And then we had an order block. So if you take liquidity into a point of interest and the context is proper, meaning we are in a premium. So you have all the elements. Okay, well, buy side was taken into an order block in a premium, right? So you're going to go down for sell side liquidity at that point. But that doesn't necessarily mean, like a lot of people, they'll learn a course and they'll say, okay, you know, confirmation here, short all the way down here. And it's not always that simple. If it was that easy, believe me, everybody would be rich. You know, that does happen, but that's once everything is synchronized. But in order to understand, you know, where your draw is, or like why you target, what are we distributing towards? So for instance, here, this doesn't look like the most clean power of three, right? It just doesn't. So, but whenever you conceptualize it, it really does though, because you had a nice little consolidation here, and you don't need to zoom into the lower time frames. Once you start seeing this and understanding it, you just understand it. We have manipulation here, and then we started to fall back into the range. So at this point, you're just going to target the sell side of this range right here. And that's from understanding, you know, understanding what are we distributing to and what liquidity you should expect from a day trader's perspective. You don't have to swing for the fences. That all comes from understanding, you know, what was the accumulation range that set up this manipulation. So in this example, we had buy side taken out, and this is where ICT used to be like, once you take the buy side, you go to the sell side. And that just makes it sound so simple, and he just sucks at explaining things like that sometimes. But after a long time, I got it, and this is what that means, really. It's like, you're not going to take out all the sell side. So I hope this is making sense. It's something that didn't make sense to me for a long time. But once you take out the equal highs here, and you're in this AMD, because you had an accumulation under your point of interest, in this example, it was equal highs. And then you saw a sharp push up, subsequent reversal. Now, another thing you can look at, other than power of three, we'll go back to this chart. It's the Bitcoin chart. Is market maker models. Another thing that, and most of these both fall into Wyckoff too. There's a lot of different ways to look at them. So market maker models are very similar to power of three. The main difference is that I think they're a little bit harder for people to learn, but the main difference is you get a consolidation. Let's say if we have a liquidity pool up here. This is an old high or old low. And you get a nice run up and a consolidation, a push up, smart money reversal, first leg of distribution, second leg of distribution down to the lows of the original consolidation. Now, notice that there is a power of three within this. And this is where a lot of people don't even realize this, or at least I don't see it talked about much. But you have a power of three inside of this little leg right here. But you can kind of pair these together to determine what you should be targeting. For power of three, it's kind of the safe way is just targeting the original accumulation. But that's really the same thing you're doing here in a market maker model. So what you're actually doing is visualizing the process of order pairing. So understanding these patterns and linking, like kind of having that mental model that everything around smart money concepts or price action trading is going to fall into one of these two patterns, whether you realize it or not. Once you start to see that, it's going to help not only with what you decide to trade, but with your bias and with your targeting. The targeting is especially, because I know that you guys, there's been a lot of times, like let's say if you're you know, there's the whole, like, for instance, whenever there's, it's like, okay, well, we're in a range, and here's my, premium. We came up to premium, order block, change a character. I'm going to target this. And there's a reason we take partials, but a lot of times you'll just hit some area liquidity pool and just, rail. And when that happens, it's almost always either a market maker model or a missed power of 3. Or that's what it was when it used to happen to me. Maybe in this example right here, let's say we had a big push down, and this was your external range right here, this to this. You came back up, had a market maker model, and let's make this a little, this box. Trying to see if I drew it. I'm trying to draw this for education here. So let's say this was the low of the range, but then you had this market maker model, and you see price pipped it out, and then you see this get preserved, and it just rushes back up. And there's some kind of crazy external liquidity or internal liquidity up here. Oftentimes, if you're in a short from up here and you get stopped out at break even, or you didn't trim as much, you could have avoided that by pinpointing one thing. And the same with power of 3. It's what is the original accumulation. So again, going back to what I started this with, everything in smart money concepts goes around accumulation, manipulation, distribution. And then we're going to go back into this in some form or fashion. And it's not always just going to be, it's not just so simple as, boom, okay, easy, boom. If it was that easy, it's just, but I mean, at the same time, it kind of is. It is, but it takes time to start spotting it like that. So the whole idea that I want to push or cement in your brain is that everything comes back to it's full circle. So if we are trying to deal with an algorithm, whatever, or it's market manipulation, however you want to interpret it to make it sound better or understand it better, all you really need to know is that obviously things are calculated, whether it's algorithmic or whether it's whatever, who knows, math, I don't know. But that's why a lot of these major funds are quant and using algorithms. I mean, you can literally go read about some of the most profitable funds out there. They're all using algorithms, but anyways, that's all besides the point. But what I'm trying to instill in your brain is that everything comes back to the original accumulation of whatever started the cycle you're in. So for example, I want to delete all this. We'll take a look at Bitcoin. So whenever we look at Bitcoin, obviously we had this massive bull run here. And the first, real kind of market manipulation we had in that bull run, because it was just up only. I mean, if you bought COVID, I mean, you literally didn't have to do anything. There was no market manipulation. You weren't even getting stop hunted. Like literally, if you bought down here, most of the time you didn't even come back and touch sell side liquidity. So once it started getting manipulated back up in here, that was your original consolidation. Because now this is the footprint that there are indeed institutions involved. There is manipulation at play. All right, so that's your original consolidation in a market maker model. Right? So then you have some run up before your smart money reversal. And there's a whole video on market maker models I have if you don't understand them. So there's your run up. This is kind of your last consolidation before the reversal. Smart money reversal right there. Second or first leg of distribution. Second leg of distribution. Sell side liquidity taken out. It's not on this chart, but it is on nearly everything else. But let me just put this low for now. I'm on Bitfinex if you're wondering why it's weird. I just don't want to mark my other charts up. But the whole ideology here, and you can go on a weekly and say it was the weekly power of 3. Right? Accumulation, manipulation, distribution. It's the same concepts. Again, and now this is on a daily chart on Bitcoin. But you can do the same thing on 1 minute charts. Here, actually, let me find I have a, so I can find an old post. Because I posted a video or a picture. Is there even like a way I can do that? I have a picture I posted on here that's, I think it's this. Yeah, right here. So this is the 1 minute of a, trying to open a new window. Okay, the quality is terrible. Let me try this a different way. Okay, I guess quality is just terrible. You can still see the general understanding. But this is on a 1 minute chart. So the same occurrences happen, and this was just, there was some kind of point of interest, so it looks like a fair value gap fulfill on the 1 minute. So the price had this original consolidation, run up to support, smart money reversal, second leg, and so forth. I didn't map them all out. But the point is, at some point, you know, if you don't look at this like this, you would just look at like, okay, break a structure, choke. But how do you know necessarily when to trade? Because if you look here, there's a change of character there. It got stopped out. But again, it's just being aware of the whole process of order pairing and the whole manipulation process. It's not always going to be just as simple as, you know, POI choke, like, you know, here's your point of interest, bam, okay, trade, you know, target the week low. It's just not that simple. It's just not, right? If it was that simple, we'd all, I mean, sometimes it's free like that, but once you understand things from, you know, these patterns perspective, I think it's a lot easier to kind of protect yourself from getting into bad trades. And also, I mean, it just helps a lot with bias. It helps a ton once you start to understand them and realize that they're so overcomplicated. They're not that, you know, hard. So again, the whole point of the power of three, we'll look at this, and we traded a lot of these with crypto. Like we'll just go to some we traded. Verified. Oops. It was perp. I hate BitGet, man. They fucked up TradingView. Nobody wants to look at BitGet. So here's the power of three. So we had a consolidation, manipulation, distribution. We caught this too. I don't know if you guys have, some of you guys may have not been in here. This is like last month or 2 months ago. You can go back and look in the crypto trades, but the whole idea of the power of three is to catch the move once it falls back into the range. So this can be a kind of an added discretionary confluence for those who are trying to trade with market structure confirmations, and use it as kind of on top of your market structure and your point of interest and the rest of your trading plan. You use it as like an extra guiding light. So for example, we have a consolidation here, and if we manipulate out of that consolidation, we have a sharp push out of it, and we are to continue, we shouldn't see a sharp push back into this. You know, if you have just a range, big push out, and then it comes right back in, that shows you that these stops were being bought by a very large force. So that's exactly what we see here. We come back to the range of displacement, and as soon as I get that kind of confirmation, notice we're in a fair value gap. I literally got messages where people are like, why are you longing right into this fair value gap? Right? We've had little drawdown, massive 100% move. And it's just simply from under. I would have longed that a long time ago. I would have been scared of long that because I would have said, oh, okay, well, bearish structure here, you know, displacement, I'm going to short from this fair value gap. And that's what simple SMC will do to you. But if you understand the process of what's actually going on, because everything goes back to accumulation, manipulation, distribution, literally every last thing. We can look at Bitcoins as well. And this is why we've been calling 25K for so long. Accumulation, manipulation, distribution. So you see how the displacement is very important. So notice how here we came in, we fell right back in the range. So at that point, you don't really want to entertain it too much. But once we come in, you know, close a full-bodied candle like this, something like that, that is where you look. And you're not going to always get... Another thing this helps with is you're not going to always get a retracement. So like, for instance, a lot of people may have, you know, had this shift and they said, okay, I'm going to wait for price to come back down to discount. However they mapped it, you know, the lowest low, whatever. They're okay, and it just doesn't. It's like, oh, this is easy. Fair value gap at discount that caused the break of structure along there, and you're just left in the dust. And it's from not understanding that there's no reason for us to fall back down to that level. There's absolutely no reason to come back because if you understand the process of order pairing, well, they've already been paired. Market manipulators have already gotten to the market all in here. Why would they need to bring price down? They're going straight for buy-side liquidity. And this can help you, whenever, if I'm on a 1 minute and I see something like this here, I took this trade the other day. Let's do ES instead. I took this yesterday morning. It was like at 10 a.m. I could have held it. I was kind of sick after. So this was, let me draw the liquidity out. So this is when we came to the market. I talked at these equal highs. I put on Twitter that we were gonna, oh, that's the range, that we were gonna take out these equal highs. It happened overnight, and then I saw that we had nice displacement above them. So that tells me price is reaching higher. So it's in distribution mode. Again, if we look here, Haas actually called this out last week at some point. Again, consolidation. So it's our accumulation, manipulation, distribution. And this caused me to take a loss. We took a loss together on ES, I think, in this day, right in here. So I didn't see it, and that caused me a loss. And that's kind of the part of the inspiration why I wanted to go over this class today, because it's still, you're still going to make mistakes, but the more aware you are of this, the less you're going to make over time. And when you do make them, you're going to know why you made them. So again, at that point, I came into the market and said, okay, we're going for buy side. I'm pretty confident in that. So that made me take a trade that I usually wouldn't necessarily take, because if we look, 10 a.m. we shifted out, or took out sell side. This is kind of the model we look for. Immediate market structure shift. But usually I would want to see at least a little bit more retracement for this big of a move, and I would usually want to use this as the stop. So I would have waited until we got in here. But in this example, I knew that price is drawing extremely fast to the upside because we're in the distribution phase. Again, there's no reason to come down. This is basically your best opportunity. It already happened. It's not going to come back down one more time. Then we're moving up. I could have held it for much longer, as you guys see, but again, that's okay. I just held to the range high because that was the distribution target. Now, again, this goes in hand with bias, which that's gonna be the next episode we do in this series. It's gonna be daily bias, even though we have an old one too. So if you want to watch that in the meantime, it's in this playlist. But on top of that, we had met our daily power of 3 target. So again, accumulation, manipulation, distribution. So we go to the lower time frames, you see the same thing happening, but in the opposite side, which would match the fact that we've taken out this sell side liquidity, because now we have a reason to move back up to at least a discount. All right, which is definitely what's going on here. Like that level for yes. But that was the gist of what I wanted to go over today. We can answer any questions, anything you may have. And that's a little shorter than usual, but I don't want to just kind of beat on a dead horse. I think I got the gist out of those two patterns. Yeah, if anybody has any questions, go ahead and bring them out now. Are we still in link? I have no idea. That wasn't That wasn't my trade. Can I please summarize the two patterns once more quickly? Like just the name and what to look at. I heard the second, but not the first. Sure, yeah. So, power of 3 is the first one we went over, and it's accumulation, manipulation, distribution. So basically, it's just the cycles of the market. It's everything that is in smart money kind of goes hand in hand around this. So it's just, if we look at smart money, mainly it is price being manipulated, liquidity being taken into a, let's start like this, into a point of interest. So we'll say that this is the point of interest, whatever it is. It could be an order block, breaker block, liquidity pool, whatever. You're going to want to see price consolidate above it, push down into it, maybe hang out there for a second and come back into this range here with force, with displacement. And that indicates that these stops were bought up down here. All the people got stopped out here. And then there was some old level that was mitigated. Now, or this can be another low. It could be just another higher time frame low. And again, any point of interest. So then once the price comes back up into the range with force, you then target the range high. So for a live example of that, or I guess a chart example would be something like this. Got a consolidation, a massive push down. Also, this was inspired by the FTX crash, so massive manipulation. Everybody said, oh my God, crypto's dead, it's over, it's done for, right? All the news blogs are posting that crypto is done, scams, be careful of crypto scams. And guess what happens? All those people who sold, whales bought it up and pushed it right back up to anybody who wanted to short. Hopefully that helped. That's a pretty good summary, I feel like. Cool, I'm glad. Yeah, the stream will be posted to YouTube. And yeah, definitely, Mr. Manny. I mean, at the end of the day, like, I think it's clear. Like, I don't know if it's someone or a bunch of whatever. Who knows what? But at the end of the day, it's pretty clear that we see that the market has manipulated. We get pushed out under a level where everybody thinks we're going to go down. We come right back up. There's tons of, and that's pretty much all smart money right there. When you really think about it, that all of it comes back to some form or fashion of that. Well, I think there's no questions. Just keep me updated if you guys watch this later on. If you're watching the recording this and have questions, feel free to ask me. Anything, DMs are always open, and I will see you guys on Tuesday. Have a good weekend.